Hello fellow intelligent investors, my name is René Selman and today I want to discuss Mohnish Pabrai's 100 bagger framework. He recently spoke to students of a university in Beijing and outlined various paths that businesses can take to return $100 for $1 invested. And moreover, he introduced a new rule that he plans to stick to in the future, and he referred to it as the $50 billion rule. And today I want to talk about this rule, and so without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Selman and I'll teach you how you can manage and invest your money with confidence, a long-term vision and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Okay. Maybe we first need to define the term 100 bagger. And in fact, maybe we should start with the term multi-bagger. Well, a multi-bagger is an investment that has gained several times its original value. And each bag basically represents your entire original investment. So let's say you invested $1,000 in a stock and your holding is now worth $2,000. You now have a 2-bagger. And if that investment would turn into $10,000, it would be a 10-bagger. Let's say that investment continues to appreciate and is eventually worth $100,000, well then it can be considered a 100 bagger. And as I said in the introduction, 100 baggers are stocks that return $100 for every $1 invested. And that means an investment of $10,000 would turn into $1 million. I think it is fair to say that the term 100 bagger was popularized again in the 21st century, or maybe in the recent years, by Chris Meyer, who is the author of the wonderful book 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. And he in turn found his inspiration in Thomas Phelps' book 100 to 1 in the Stock Market. I think this book is really one of the best investment books that has been written in the recent past. And interestingly, if you look closely, you can see Chris Meyer's book on the top of Pabrai's desk in one of his recent videos. So clearly, Mohnish Pabrai was inspired by Meyer's book when he was developing his 100 bagger framework. Alright, so before we move on, I just wanted to let you know that if you enjoy my content, you could help me out a great deal if you just quickly hit the like button or leave a comment. Because any form of engagement is obviously much appreciated, but it would also help me grow the channel. Thanks. Alright, to get back to Pabrai. In his talk at the Chinese university, he himself stressed that he's going through a renaissance right now. He said that there were 2 years in his investment career that stand out in terms of the impact they had on his investment style or strategy. And 2020 was one of these years. And to quote him here, he said, "I wish I had gone through this renaissance many years ago, but still, we are old too soon and wise too late. But you know, better late than never." Pabrai is 56 right now. So if you are younger than he is right now, you can consider yourself lucky to be introduced to this idea early on. And so the transformation he's making right now is a transformation from a deep value investor who is maybe primarily looking for dirt cheap businesses that are not necessarily of above average quality, to more of a compounder investor who is looking for stocks of very high quality that he can then hold for a very long time. And essentially you are letting the business do the work as opposed to you doing the work with your trading activity. And if I had to use Pabrai's own terminology here, then I'd have to point out that Pabrai himself distinguishes between growing pies, so those are the compounding machines with long run rates for growth and a 100 bagger potential, and discounted pies that will rarely give you a return of more than 2x or maybe 3x. Well, a major problem of these discounted pies is that you will constantly have to look for new discounted pies, because whenever you sell a previous investment where the price and where the gap between price and value has closed, you are destined to find another one that can replace that original investment. And on the other hand, the biggest challenge of investing in compounder stocks, compounder type of businesses, is certainly that they don't look optically cheap, which means that they are often trading at high double-digit valuation multiples. And not every investor will feel comfortable with such high valuation multiples. So compounder investors will need to develop a high degree of conviction that the business is indeed of superior quality, that it does indeed have a long runway for growth ahead of it. Because then, and if a company can grow at high rates for a long period of time, these high valuation multiples may actually be justified. So in his talk, Pabrai actually introduced a concept that he has developed to find these 100 beggars. He points out that he was actually hesitating and not sure whether he should share it publicly, because then his competition could pick up the concept as well. But he felt like the feedback that he will get to improve the framework will likely outweigh the risk of openly talking about it. I think one can say that his 100 beggar framework consists of two components. And I will talk about one of these components in this video, and I actually plan to do another video on the second component fairly soon. I think I can say that. And yes, so the first component of his framework is the so-called $50 billion rule. And what Pabrai pointed out is that there were around 3,700 IPOs in the US in the last 20 years. However, of these 3,700 businesses, only 9 ever reached or exceeded a market cap of more than $100 billion. And based on this, Pabrai figured that most companies will struggle to ever reach or exceed a market cap of $50 billion. And so if you are looking for 100 beggars, you really need to look at companies with small market capitalizations. And essentially, Pabrai came up with 2 rules of thumb. The first one is that if you want to enjoy a 10 bagger, you will have to look for businesses with a market cap below $5 billion. And the second one is that if you want to enjoy the returns of a 100 bagger, you really have to look for businesses with a market cap of $500 million or less. Now clearly this $50 billion rule sounds easy and maybe too good to be true. I mean, in the US alone there are thousands of small and micro cap companies, but clearly not all of these businesses are going to succeed and become 10 or 100 beggars. In fact, many small enterprises fail. And I mean, just ask yourself, how many microcap investors actually outperformed someone who was primarily invested in the FANG stocks over the last, say, 10 years? I assume not very many. I don't know, maybe 5%. So what's important to acknowledge is that the younger the firm is, the wider the range of outcomes. Young and immature firms usually don't have as strong moats as maybe more mature companies have with a very established business model. And as we all know, capitalism can be quite brutal, and if you don't have a moat, a wide and deep moat, defending your wonderful business castle, you might eventually get into trouble as competition will grab your market share, offer lower priced products, or simply come up with better products or services. But nonetheless, in a way what Pabrai said reminded me of the Livian Capital interview that I referenced in my last video. And he pointed out that it might be more appealing to actually invest in a company that's just building the moat rather than a company with a moat that has already been built. So in a way he's making a similar point like Pabrai, I would say. However, as I just said, there are 2 potential sources of error if you invest in younger companies with a small or micro market cap. One might be that the company fails to build or deepen its moat. And another one might be that you are wrong in your judgment with regard to the strength of the potential moat that is just being built, and also management's capabilities to actually execute properly. So there's certainly a decent level of risk involved if you invest in micro and small cap companies. And maybe you might have to diversify a little more than you would need to if you only invest in more established companies. Because the outcome of micro or small cap stocks is usually just much harder to predict. Nonetheless, it's certainly correct that the easiest way to have a high compound rate for a long period of time is to start from a small base. And just to stress maybe the importance of a small market capitalization when seeking 100 beggars, I would like to quote Chris Meyer here. In the book that I mentioned earlier, Chris Meyer looked at all 100 beggar stocks of the last 52 years. And he concluded the following. It's also worth considering the size of these companies when they started their march. Now I hesitate to make generalizations from the statistics, as I've said, and that's why my focus is more on anecdotal evidence and the ideas or theories behind 100 beggars. With that warning, I'll add that the median sales figure for the 365 names at the start was about $170 million. And the median market cap was about $500 million. And in his book, Chris Meyer actually referenced another study that looked at 10 beggars. In fact, it's a 45-slide deck presentation called 10x Return Stocks in the Last 15 Years by Kevin Martelli. And in the conclusion of this analysis, the authors also concluded, small is beautiful. 68% of multi-baggers in the selected sample were trading below 300 million US dollars of market cap at their low point. For many established investment funds, these opportunities are simply inaccessible, and this is why they are overlooked and mispriced by the market. So that's the first of two components of Pabrai's 100 bagger framework. Getting in early and holding on throughout is key. Investors need to maintain conviction in time of, say, temporary headwinds, and should only exit a stock when it's absolutely obvious that some kind of long-term decline has started, and not just when the stock temporarily meets or exceeds its intrinsic value. As I said, I will do a video on the second component of Pabrai's 100 bagger framework fairly soon. So that's it for today, and as always, may your finances and investments prosper. Good luck.